Right now, property investors are drowning in opinions, and most of them are wrong. People think that the right property has to look a certain way, has to be in a certain suburb, tick every box in a checklist, or be timed perfectly with the market. But the truth is that most investors are basing decisions on myths or ideas they picked up somewhere along the way and not in reality. If you're here, you're probably wanting clarity, not noise. So today, we've got a bunch of questions that are on people's minds, and we're going to break down the biggest things property investors are getting completely wrong and what actually matters in the real world. So let's get into it. Goose, I'm just going to launch into a really niche question.
Okay.
Considering everything you know about the Australian market and everything we've built with Dashdot, what do you say to someone who says, I want a brick house and nothing else? I don't want weatherboard, only brick. Thank you.
Okay, that's a good question. That is kind of niche. I would say, firstly, that the more conditions you put on your purchase criteria, the more you reduce your total opportunity volume. So that's the first thing. The second thing, and so if it's one thing to say I want brick and not weatherboard, right? That's a condition. But you could go further and say, well, it's got to be brick and it's got to be on a block that's no smaller than 650 square meters, and it's got to be within 500 meters of a school, and it has to have access to, it's got to be within 500 meters of a bus stop, and it can't have a sloping block, and it can't have an odd shaped block, and it can't have stumps, and it can't have a tin roof. It can only have tile, and very quickly you can say, by the way, all of those things are things that people would say or have said or could say. And all of those things, if you just start to compound them up, then you start to really narrow the aperture of the total potential opportunity that you could buy. Because yes, in 2024, there was about 686,000 residential property transactions. So in the grand scheme of things, there's a lot of transactions. However, only a small number of those transactions are good investments, as I would define in this context as being in the right place at the right time. So there's 15,353 suburbs, towns and suburbs in Australia.
We lost a couple of suburbs.
No, I just was saying 63 and it was 53. I just got it slightly wrong. So pardon me. I guess crazy, there's 15,353 towns and suburbs in Australia. At any given point in time, we, Dashdot, are buying in, let's call it 100, right? So that's less than 1% of suburbs. And so pragmatically speaking, you're already narrowing the total opportunity base down to like the top 1% of suburbs if you really want to get the right properties in the right place at the right time. If you then start going, okay, well, it's got to meet all of these other conditions and criteria, then you start to narrow that. Now, there are some criteria that make sense, like don't buy in a flood zone. Cool. Like that makes sense. There's some stuff which is important to pay attention to, and there's other stuff that isn't that important to pay attention to. And as a general principle, I think that particularly newer investors are more preoccupied with how a property looks than they need to be. Probably, right? That is just probably the easiest way to round out that statement. More than they need to be. And the challenge with that is there's more new investors than there are seasoned investors, statistically speaking, right? The largest cohort of property investors have got 0 properties. We're seeing the percentage of property investors increasing, all of that kind of stuff. So most property investors are novice. Even if you've bought one investment property, you're still a novice, right? So you're learning, right? But you're still a novice. And so most people, when they're early in their investment journey, they're really fixated on like, oh, it's got to look good, and whether it's conscious or unconscious, they have a bias to think, would I want to live there? Would I live there? Which is one of the biggest mistakes that you can make as a property investor, because you're not living there. If you wanted to live there, you would already probably be living in that suburb, for example. And so what you need to be able to decipher is it appropriate for the market, not necessarily appropriate for you. there's lots of properties in Townsville, for example, that lots of people who live in Sydney would never want to live in, but they're completely normal looking properties for Townsville. So if you're living in Townsville, I mean, it's just another house. Doesn't really matter. And so overlaying your personal biases on this kind of stuff can really kind of lead you in the wrong direction. Now, I'm gonna expand. I'm going to spend a bit of time on this one, Gabby. So I don't know how many more questions I have, but I'm going to spend a bit of time here because it's very important. What you asked about was brick versus weatherboard, but I actually think that the broader conversation is perception of quality versus a perception of a lack of quality, right? And so the implication with brick versus weatherboard. I mean, look, there could be some argument that you might say, well, brick versus weatherboard. If it's brand new weatherboard or brand new brick, well, you don't need to repaint. You'll need to repaint the weatherboards at some point. And so you could argue that the point of view might be like a maintenance thing. Let's just debunk that for a second. Okay. The cost of repainting a house once every 10 or 20 years is minuscule compared to the returns that you're going to get from that property over time. Right. So just chill out on that. Generally, when people are saying, I don't want to buy weatherboard, or I don't want to buy fibro, or I don't want to buy this, or I don't want to buy that, what they're actually trying to say is, I want a property that I perceive to be of higher quality, right? Or another way to say that is a pristine property. I want a property that looks good and has no problems. There's nothing wrong with it. I don't need to fix anything, and it's perfect. It comes out of the box. It's almost like brand new. That's what I want. I want to buy the best property in the best place at the best time. And by best property, I mean it can't have anything wrong with it at all.
Which, for a lot of people, obviously that would be the preference, is to have an asset that has no issues. Obviously, we would all love that.
I mean, of course, like, let's not be silly. Like, if you could, of course, buy a property that had literally zero problems and everything had been done, they just replaced the roof and everything was perfect. They'd redone everything and everything was perfect, and it was at reasonable market value or less than market value, and it was in the right suburb, and it was at the right time. Then, of course, like, you're not going to not buy that. That's like, of course, that would be great. But in a very practical sense, that's not most properties. And so when people say things like, oh, I want brick, not weatherboard, what they're really trying to say is, I don't want to buy an old clunker. Right? I don't want to buy some shitbox of a property. That's really what they're trying to say. But they just don't have the framework to be able to articulate that. And I think that is a really interesting point of view, because I think that actually stops people buying good properties. I've seen this happen firsthand. I've seen people who have turned down really good. Well, let me rephrase that. They've turned down properties that have looked like, excuse my language, a bucket of shit, basically, because they needed a paint job, and the weatherboards were like, they were like, let's call it a clunker, right? They turned down a clunker, right? Because they couldn't see that it was in the right property, the right place at the right time. And then have subsequently gone and bought something else, which they perceived to have been nicer, but has performed worse. And I would prefer to have a clunker in the right place at the right time than a pristine property in the wrong place at the wrong time. So just to kind of push this to the edges, we're buying in, let's call it less than 1% of suburbs. And would I prefer to buy an old 1960 build property that's weatherboard on stumps where half the stumps are rotted, but that it's in the right location? Now, location goes down further than just suburb, just to be clear. There's suburb, there's street, we get into like there's nuances. You can't just say this suburb works, because within a suburb, there's going to be dynamic differences depending on things like crime rates and, public housing, flood zones, and there's all different stuff. So you can't just blanket say this suburb equals good. It's like, well, this suburb in principle is good, but actually it's this part of this suburb that is good. And the difference between the right location and the wrong location within a suburb can be a couple hundred meters, right? And we saw this happen in places like Bundaberg. We've seen it happen in places like Townsville as well, where there's a fine line in some places where, this is a great place to buy, and that place is underwater half the time, so don't buy there, and people buy in the wrong spot, same suburb but wrong property. Now, just to push this to the edges, so I would prefer to buy a 1960s property that's weatherboard on stumps where half the stumps are rotten, but to buy in the right location at the right time than to buy some brand new pristine property 400 kilometers north of Broken Hill, right? Or, 700 kilometers west of Townsville, right? Like what's that going to do for me? Oh, it's pristine, it's beautiful, and it's wonderful, and it's fantastic, and there's nothing wrong with it. It's like, yeah, but it's also not in the right place at the right time. So what's it going to do for you? And this is actually a really, and I'm going to show some examples, by the way. I've got a few examples, not a bunch. I've got, well, enough that some people might call it a bunch.
A bundle.
I've got some,
call it a bundle.
A bundle, yeah. A cluster. A bundle. Bundle's better.
A clunker cluster.
Yeah, I've got a clunker cluster. But this idea is also what leads people to choose to go and buy new build, off the plan, developer stuff, right? It's this thinking of like, why would I go and buy a secondhand property, right? When I could go buy a new one.
Mm-hmm.
Why would I? And there's a lot that's wrong with that, because if you're buying an established property in an established neighborhood that's already found its kind of price equilibrium over time, because it's been an established suburb for 20 or 30 or 40 or 50 or 60 or 70 or 80 years, and there's good community that's built around it, and there's an establishment there, all right, of like network effects that happen within the community, versus like if I think about Melbourne, for example, like, are you better off to buy in an established suburb in Melbourne, or some outer ring new development where there's nothing there except a whole bunch of cookie cutter development houses that look exactly the same? There's kind of like really eerie looking developments where literally all the houses are all exactly the same. Now, in those outer ring developments, yeah, you're going to get a brand new property. But also, by the way, that doesn't mean that it's good, because a lot of those properties still have problems. And so the quest,
particularly in more recent years, where builders and developers are looking to trim costs and maintain profits, so they're cutting costs and the quality gets worse. I think everyone knows that, has experienced a house that's been built most recently, and actually you'd expect the quality to be great because the technology should be improving, but it's actually getting worse because they're cutting corners. So there's that to consider as
well, this is true, and to that extent as well. It's like you can get a brand new property, and it can be signed off and whatever. But if you go get an independent certifier to come back through and check stuff, I guarantee you a certifier will be able to find problems with that property, even if it's brand new. So buying new or getting something that looks new is not a guarantee of quality. It's not a guarantee of anything. And what it comes back down to is actually understanding the priorities. Now, the number one priority is obviously your strategy, right? What does your portfolio need in order to get you from where you are now to where you want to be? That's the number one question to answer. That's the number one. Because otherwise you're just buying properties, right? Just and with no plan, right? You don't know, and you're going to end up a statistic like everybody else and not actually achieve your goals. So the very, 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 very first thing is you need a plan, and you have to have a strategy that is actually going to be designed to get you from where you are now to where you want to be. Because otherwise you couldn't possibly know if you're buying the right property, right? Putting that aside, if we just think about the hierarchy of how I would think about, things like looks. The number one priority is location and timing. Now, should it be location, then timing and then location? I think they're inextricably linked. So I would say location and timing is the most important thing. Now, one could argue that you could buy in the right location at the wrong time, and through the passage of time, that would still work out just fine. And I would agree with that in principle. However, what is actually important is that you are thinking about the timing of that location as well, right? So we've talked quite a lot about the fact that cycles are shortening, and they are measurably so shortening. But if we go back a few years, there was times where the right location may sit stagnant for 10 years before it had another growth spurt. So you could pick the right spot and then still be wrong by 8 years and have 8 years of no growth, or 9 years of no growth, and then get growth. And it's like, well, you picked the right place, but the timing was so wrong that your investment actually went wrong. Now, cycles are shortening. And so what that, and time will prove all of this out. What that sort of implies is that even if you get the right location, but the timing's slightly wrong, it's less of a risk than it used to be because cycles are shortening. But necessarily timing still matters. So location and timing are the two most important things. And in fact, when we started Dashdot, we didn't have all the sophisticated technology that we have today. We've built that over the last few years. We've spent nearly $7 million over the last 6.5 years just building technology and solutions that really solve the problems of property investors at every stage of the cycle. We started by with our real estate market intelligence technology, and before we had that, we thought, probably similarly to most investors, that you needed to have a few different arrows in your quiver. So we always said to buy high cash flow positive properties in high growth areas with value add potential. Now, we discussed cash flow in the last episode, where with interest rates where they're at and with yields where they are, and the market has shifted much more towards a growth-based market. And so, buying a cash flow positive property isn't the specific objective. The specific objective in your property portfolio is maximize your return on invested capital, build your wealth, and then you can rotate that capital into cash flowing assets later on. That's how you replace your income. It's really not that hard. You just need to know what to focus on first. Then the other part of it, so we had cash flow positive properties in high growth areas with value add potential, right? Because we kind of were like, well, yeah, look, the growth is good, but what if you can't, what if you don't get the growth? Like, what if you kind of think that you picked the right place, but then you don't pick the right place? Then you need some way to be able to manufacture equity and do that faster. And so the best way to do that is through, say, renovations, or you want to have some kind of ace up your sleeve so that at a later date you can maximize the value, whether it be doing a splitter block or something like that. And so this was our prevailing logic for a little while, at least a couple of years, until we developed the capability to work out that 80% of the value creation happens by picking the right market at the right time. And there was a great study done by McKinsey about businesses. It's a fantastic, I wish I could remember the name of the book. It's a fantastic book. I read it twice, which is not common for me to read a book twice. But it was really talking about like what drives success in business. And there were three factors, but the two primary factors were picking the right. Actually, sorry, the number one factor was to be in a business in an industry that was growing, right? So basically, putting yourself in the right business in an industry or segment that was already growing, because that is going to take you in the right direction. And so identifying the right location, the right timing, and then the sub location, the intra suburb location of like, how do we pick the right corner, the right street, the right whatever, that is important, because again, you don't want to get that wrong. But that's going to do 80% of the heavy lifting. And I know I'm waffling on a little bit here, Gabby, but I actually have some examples, because a lot of people think, oh, that's nice in theory, but like, how does this play out in practice? So I want to share a cluster of clunkers with you guys.
We're ready.
So this property here, we bought in for a client. We bought that in March of 2020. Now, can you see it? Yeah, okay, we're sharing. Yeah.
Yep.
So anyone would look at this property and they would think, wow, is that like a good investment? And by the way, you can see the kind of brick around the bottom of that as well. That's really just hiding the really trashed stumps. I think there was 25 stumps in this property, if I remember correctly, and 15 of them were rotted. Now, our client bought that in March of 2020. We did negotiate a little bit of money off in order to replace the stumps. It was about $1,000 a stump. We negotiated about $15,000 off the purchase price. This property was purchased for $275,000. Now, most people would look at this and they'd be like, oh my God, I don't want to buy that. Ugh, yuck. This property sold for $645,000 in 2025. So that's a growth of 134% in, what's that, 5-6 years, right? So this is one example.
Can I just make a comment?
Yeah, you can make a comment, Gabby.
Can I make a comment? So I know that we're kind of bringing up these examples where it's like they don't fit the pristine bill that people obviously hope. Like, because a lot of people spend a lot of years building up their deposit, And then they finally get to the point of like, okay, I'm actually going to buy an investment property finally.
Yep.
And so the criteria is very long. So many analogies come up in our lives that relate to like relationships. Similar, if you're like finally hitting the market, you're trying to find the perfect partner. A lot of people start with this laundry list of like, it's just who they have to be. They have to tick all of these boxes. Otherwise, I'm not going to be happy. And I just know that something's going to go wrong. But like these particular properties, we may not personally feel really called to live in them, but a lot of people are totally happy in these places. Like these kind of houses, I grew up in these kind of houses. Like there are so many people that need this kind of housing.
Yeah.
That
So
they're
wanna-
happy to do that as well.
I want to get onto that point in a moment, because this is where it comes down to like suburb appropriate and like what kind of people would want to live there. I think it's a really good point. I think we should really expand on that in a moment. When you were just talking about the kind of like partner analogy, I was actually thinking about when you met me, I was a clunker, you know, like I was a wild man. Oh, truly.
That's how I introduced you to my family.
Yeah. I've just found this clunker. I bet you.
This
I
is
bet you in a few years
Goose.
it's going to
He's
be
a
worth
clunker.
shitloads. Yeah. But it's a
He's
good
gonna
get
be
because in a
worth
few years he's going to be worth shitloads. This you know, steaming
Just got to
alcoholic
renovate him a little.
piece of crap.
Puff him up.
Wow,
I felt
you did
good.
well. You did well. Yeah, I mean, you bought a clunker that's performed well. So I want to.
Oh my god, I need to call you that from now on.
It's my new pet name, Clunker. All right. I want to share another one here as well. Now, and I'm going to make some caveats to all of this stuff in a second, so just bear with me, because I think it's important for people to see some real examples. So the last example I showed was bought for $275 and sold for $645, 134% growth. This property here, I'm going to show my screw.
You're going to show your screw.
I'm going to show my screw.
You're going to show it. Okay.
So this property here, again, look, this is fibro. This is not, this is fibro and stumps. And by the way, I hope there's not kids listening. I feel a bit sweary today. I spoke to our head of property about this, and he said the stumps were all fucked and it needed new wiring. And the stumps were all fucked and all the electricals needed to be replaced. Right? So, are we calling this like a pristine property? No, we're not calling this a pristine property. But it was bought for, again, $275,000. And it sold for $591,000 in January of this year. So that was 115% growth in 4 years, actually, this property. Now, I've got a few more examples as well. So maybe I'll just do like one more example, because we don't want to just sit here all day staring at properties. But let me just do one. Let me just do one more. Okay.
I think a lot of our listeners would love that. But
well, okay. let us know in the chat. Let us know in the chat if you want to just sit here all day staring at properties and watch me talk about them. So, so this property here, again, a lot of people would. Oh, we're not sharing. Okay. Again, this property here, a lot of people would probably say, "Ugh, that's not for me. I don't want to live there. I don't want to live there. Rusty gate, elevated, cinder block underneath. I don't know about that kitchen. How do I feel about the stairs?" So this property was bought for $220,000 and has not yet sold, but the latest valuation was $525,000, which is 138.9% growth in 4 years. Now, so the reason I make those points is because these properties may not have appeared desirable. And yes, I do know that all of those numbers started with twos, and you can't buy properties in the twos anymore that are already good, right? But this is what happens through the passage of time, is the properties grow, right? The property market is growing. So if you're listening to this and you're like, well, you can't buy 275 anymore, so therefore that's all crap. It's like, sure, but what is 400 today? Well, in 4 years' time, we'll be saying, wow, you can't buy $400,000 properties anymore. That's what's going to happen in 4 years' time. So just calm the farm. One sec, Gabby, just quickly. I just want to make the point here that I'm showing some examples, and I could show you hundreds more examples just like this. What I'm not saying is that you should preferentially seek properties that are clunkers. You shouldn't preferentially seek clunkers. But what I am saying is that you shouldn't necessarily actively avoid them either, right? You should be able to view them on their merits. And what is interesting here, and so I know you've got a point to make, Gabby. What is interesting here, though, is your preferences are not necessarily the market's preferences. And so when you have a location that is in a premium point of desirability, a lot of people want to move there, right? A lot of people desire to live there for whatever reason, or a lot of people desire to buy there because it could be a combination of investors and homeowners. Properties like this represent a great opportunity for very specific people. So it could be a young family that's just trying to get their first foot on the ladder, that's trying to buy. So you still have a lot of demand from people who are like, look, I know it's not great, but it's an entry level property. Like, I want to get in and we can fix stuff up and we can do all this kind of stuff. There's a lot of like that. There's also, those properties tend to have slightly higher yields relative to other properties in the same suburb, because their prices will tend to be a little bit lower than the median. And so you can buy a property that has a slightly higher yield, which can support borrowing and support to actually have investor demand. And so they may not, but they could be right next to some beautiful brick, nice brand new tin roof house. It could be cheaper. It could actually provide potentially even more growth relative to the other properties around it, because it serves this. It's kind of like the ugly duckling, and it kind of serves a specific market segment. And they tend to be the ones that have the biggest kind of price elasticity. Now, that is not a hard and fast rule. I'm not trying to sit here and say, okay, find the perfect suburb and then go find the worst property, because you can buy duds, right? And you also need to be very mindful that whenever you're buying a property like that, the level of maintenance needs to be within your acceptable range of tolerance. My point there is your acceptable range of tolerance should probably expand, because if you think that you're not going to need to do any maintenance, you might miss out on some great opportunities. I have a lot more to say on this topic, Gabby, but I know that you've got a point to make as well.
No, my point was just going to be about that. You mentioned the price points, like starting with 2s for some of those. And those clients still had the same reaction when they were looking at these properties. They're like, do I really want to buy that?
Yeah.
Could you imagine if they didn't? Now, the first property we've talked about previously with the stumping issues, where that client, you helped them work through that process of, renegotiating and getting a little bit off, but still there was resistance to buying it because it had some issues. Now, if that client hadn't bought that property now, if he was trying to buy that property now, he, just sold it himself.
Just sold it for $645.
It's not to say that like all of these clients come in with like no resistance to buying these either, but they push through that and they make a good investment, and it pays off over the medium term. So
yeah,
that's all I want to add.
Yeah. I think it's really important, right? Important when you talk about prices, because whenever you talk about historical prices 4 or 5 years ago, necessarily the available property prices were lower, right? And so, but the same thing's happening today. Like we used to buy properties at sort of 250 was sort of the average purchase price for a little while there, and then it became 300 and 350 and 400, and prices keep going up. And so the point here is picking a property that is optimally located and optimally timed is more important than aesthetic appeal, because the aesthetic appeal still has a place in the market. Again, because it could be people who are looking to do it up, or it could be people who just don't care. We bought a property back in 2019 that we planned to start a renovation on in 2019, and we literally have, well, that's not true. We did give it a little coat of paint at one point on the inside, but honestly, it's rough. It's rough. It's a rough property. We've had tenants in there. We've had the same tenants in there for years, right? They're happy with it. We're happy with it. They're good tenants. We're sensible with the rent. We're not being ridiculous. We're happy that they're good long-term tenants. Life's good. They're happy. We're happy. No maintenance, right? Done. Easy. So these properties have a place. And I think that I'll go back to the point that I was making earlier, that particularly newer property investors have an aversion to properties that don't look the way they think their investment property portfolio should look. And that's just opinion. That's just ego and opinion of like, well, I want properties that look like this. It's like, Okay. I mean, I thought you were investing for financial returns. Or are you just investing so that you've got a nice like photo album to show people, like, look at my pretty properties. I'm going to put photos of them around the house and I'm going to look at them all day and I'm going to be really happy they look at a certain way. Because, you know, like it doesn't really matter that much. Like it's a financial investment. Now, I will again go back to the point as well. We need to be conscientious about maintenance as well. But I would also say that you can buy properties that look good, feel good, have great building and pest inspections, and then 2 months later or 3 months later, it turns out there was a problem that no one picked up, and that happens. We had that happened to one of our clients. Well, I've got a couple of stories on that. So we had a client who bought a property. All the building and pests were done. We did all the checks. Everything was, you know, hunky dory, no problem. And then about 2 months after they bought it, the deck on the back of it was an elevated deck. It was a 2-story property in Queensland. The back deck broke. Like it just busted. It busted, right? And it wasn't picked up in the building and pest. And, you know, it was just, turns out, whoops, that was a $15,000 repair that no one expected. We bought a property, and a couple of months after purchasing it, even though we had building and pest inspections done, turns out we had to replace the roof because the roof started to leak and water started to run into the house. $20,000. Didn't expect it. We had another client recently who, I actually think this story is a little bit funny, because they bought a property and it was a high set property in Queensland, and underneath was not regulation height to rent underneath.
Yep. And
we told them that you couldn't rent underneath the property. They decided to rent underneath the property anyway, and somehow the council found out, and so they sent a certifier around, and then the certifier went around the property, and there was these other buildings that had been built without a permit. You know, there was like a lean-to. There's a couple of other things that have been built without a permit. And so then the certifier walked around the house and was like, not to code, not to code, not to code, not to code, not to code. And they had this really big bill, which they actually just wouldn't have had if they just didn't illegally rent under their property where they weren't allowed to do it. Right. So, so these things, these things can happen. But anecdotally, you know, there's a lot of upside potential in these kind of properties too. So I think that, anyway, we can move on.
Cool. There's some cool comments that are coming through the chat that I just want to pull up. So Catherine, hey, hope you're well, has just added, definitely agree. I was resistant about one of my properties being kind of ugly and has performed well. Thank you for sharing, Catherine. There's this question, Goose, which I think it would actually be interesting to dig into now, from RJ, saying, I've been resistant to purchase both of my BA bought properties. How to know when your BA is making a good purchase versus when to trust your gut and turn it down. Which I think this is interesting because, you know, in this case, people see us as buyer's agents in this scenario. We're saying,
just to be clear, we're not buyer's agents. I just want to, let's be very clear and make the point that Dashdot is not a buyer's agent, right? But that's fine. Dashdot is a portfolio growth partners. But the point, I understand the point. The point remains the same. If someone that you're working with is saying buy this property and you're not sure, how do you work it out?
Yeah, I think the trust the gut thing is interesting to tap into, because there's part of it where it's like, if you genuinely don't want to buy it, then don't buy it. Like, at the end of the day, you're going to be the owner of the property. So if there is something in you that's saying like, no, like something deep, it's not your brain trying to talk you out of it. And this is the other layer. It's like, I think we have a lot of these stories and ideas that we've picked up somewhere along the way that things have to meet a certain criteria, otherwise I can't possibly invest in it. Those are the things you need to question. I don't know what your thoughts are on that, Goose.
I think that people are too emotional. So I think that, you know, like you have a sort of, like, part of your point there is that at some level you should trust your intuition, right? That's sort of part of your point.
Yep.
However, the problem with that is that most people haven't done enough reps for their intuition to be reliable, right?
To have the skill.
Yeah, you haven't developed enough understanding to have appropriate intuition. So if you went to the gym for the first time, let's say you'd never been to the gym, right? And you started to lift some weights. And this happens for everyone, Everyone. They go to the gym, they lift some weights, and it starts to feel a little hard. And they're like, oh, okay, well, I guess that's the end of the set then. Well, actually, you were nowhere near failure. You were nowhere near even stimulating muscle growth. So most people go to the gym, they don't build any muscle because they just are never that they trust their intuition of when they're pushing hard enough, and they're just not, right? They're just not. And so when you don't have the experience, you actually need to be suspicious and skeptical of your emotions, because your emotions will show up as intuition. I'm like, I don't feel like this is the right thing for me. And it's like, well, based on what? Now, I am a believer in intuition, by the way. I do think that in a general sense, I think that developing the capability to get in tune with your intuition, I think, is very useful. But that has to be built on a foundation of experience. So, for example, like I used to bake a lot with my mum. I grew up baking a lot of stuff. Like we used to bake cakes and cookies and just start baking. I spent a lot of time in the kitchen. I also became a baker at one point. So in baking, I bake by feel. I'm like, yeah, about that much flour, this much that, and I can bake by feel and bake something, and that's fine because I'm like, okay, I know the texture that should be, and I don't need to weigh the butter to the gram and stuff like that. The same thing goes in investing. It's like, unless you've developed the reps, unless you've looked at enough properties, unless you've looked at enough assets, unless you've studied enough cycles, unless you've really done the work, your emotions could show up as intuition, and that could stop you making a good decision. And this happens all the time. Particularly, and I'll just diverge a little bit, but particularly in more liquid assets like stocks and crypto, because people will convince themselves that something is true. Then they will act on that thing, which they are convinced is true, but actually is not true. And actually they lose a bunch of money because what they actually acted on was emotion and not facts. And so I would say to RJ's question, which I think is a good question, because most people are going to come across this, because it's a big purchase. Property investing is a big purchase. You're not talking like, hey, you want to go put $100 into Bitcoin or something like that. All right, like fine. You could probably live with whatever happens. Hey, it's fine. But buying a property, you're talking about a $300,000, $400,000, $500,000, $600,000, $900,000 purchase, and it can feel scary and it can feel daunting. And you may only buy 5 of them in your life. Right? You might buy thousands of shares over time, but you might only buy 5 or 6 or 7 or 8 properties, right? So the total number of like Warren Buffett has this this framework is like, imagine if you had a 20 slot punch card and you could only make 20 investments, like which holes would you punch? And so there's a degree to which that is kind of true with property investing, where it's like, okay, well, you don't have an infinite amount of punches. Like how many shots on goal are you going to have? And so necessarily, I think it's very, very, very reasonable for the emotions to be higher. And it's like, oh my God, how can I be sure about this? Is this the right idea? And so I think what you need to do is you need to be able to sort through the noise in your own mind. And you need to ask yourself, what is the actual concern? What is the actual concern? Because I think nervousness can show up as a lot of, we'll call them objections, right? So you might be nervous. What if this is what if this doesn't work out for me, right? It's probably the most fundamental nervousness. What if I buy this and it turns out to not be the right purchase? But instead of just confronting that concern, that could show up as, oh, I don't like the fence. And, I think I'm paying $5,000 too much, or, and it can manifest as these, hyper fixated points where you're like, no, this can't be the right. In fact, I actually remember one of our clients. I hope they don't mind me saying their name, Jono and Tammy, fantastic clients, total freaking legends, right? And the very first property we were buying for Jono and Tammy was in South Australia. I can't remember the suburb. It was in Adelaide, one of the suburbs of Adelaide. I remember because I was doing the buying with Jono.
Ingle Farm, maybe.
Yeah, it could have been Ingle Farm. And the shape of the block, it was a bit of an odd shaped block. And Jono nearly didn't want to buy it. He and I had some like long discussions around it. He was like, "Oh, I don't think it's going to work," so blah 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 blah, and there was a lot of argy-bargy around. When I say argy-bargy, we weren't arguing, but he was really concerned. He was fixating on this idea. Now, I don't have the stats in front of me, but that property performed like obscenely well, and it turns out the block shape didn't matter at all. Full stop. It just literally just didn't matter at all. Like not even one bit, because they got like the most offensively, ridiculously good returns ever. And so, I think you really need to be able to zoom out. I think that if you're working with someone, you should be able to say, "Hey, I'm feeling nervous about this purchase." And that person that you're speaking to should be able to say, "Great, what are you feeling nervous about?" It's like, "Well, these are the things I'm concerned about. Should I be concerned about them or should I not be concerned about them?" But you can tell a lot by how someone deals with that. If someone says, "Shut up and buy it," maybe they're not being receptive to your emotional needs, and that's not great, right? But also, if you're fixating, if you're majoring in the minors, so to speak, a bit of a reset can be really, really important. I actually had a client reach out today. Sorry, not today, a couple of days ago. And please, if you're listening to this, please don't take this as an invitation to do this. I don't have the time. But a client reached out. They had a direct line to me. One of our team members had presented a property to them. They'd reached out to me. They were super complimentary of our team member. They're like, the person I'm working with is great. We're loving the process. Everything's good. Everyone we've dealt with has been great. We've been presented this property. We think it's awesome. We're happy with everything. We're really nervous though. Can you just have a look and just like let us know? Like, because I'm feeling nervous about this. We're excited, but we're nervous and just value your opinion. And so I took a look at it, and did I study every shred of due diligence about the property? No, I didn't. I had to look through some of it. I was like, okay, so what is the property? I had to look at their strategy. I had to look at their Apex report. I had to look at their brief. I said, okay, does the property match their strategic requirements? Yes. And their constraints? Yes. Okay, boxes ticked. Good. Is it in the right suburb? And the suburb it was in, I was one of the advocates of us adding that suburb into the mix. I'm bullish on it. I'm like, cool, confident with the suburb, no problem. I had to look at the walkthrough of the property. I was like, okay, property looks to be in reasonable condition for what the market would desire. It happened to be a brick property, by the way, but it was not updated. It was dated. It kind of looked like the house that I grew up in when I was a kid. It was kind of like 80s, 90s type interior decor, but it was in good condition. Totally fine. It was in a good spot. I looked at all of those things. I said, okay, does it meet the strategy? Is the property appropriate for the location? Is it in a location that's the right time? All that kind of stuff. Bang, let's go. Yes, I think this is good. And by the way, I'll also make the point that based on the automated valuations that you see on like realestate.com.au, the price that we were going under contract on that property was at the top end of the range, right? So the top end of what we consider to be a high valuation. But I also know for a fact that if we were anything below that, we just wouldn't secure the property, because what you see on realestate.com.au and things like that doesn't actually represent current market conditions. It's always trailing by typically about 3 months-ish, right? So I was confident that even at that price, and this is what I said to them, based on your strategy and based on that location and the property's appropriateness for that location and a few other kind of key factors, you will not regret it owning this over the next few years. So all good. I would feel comfortable with that. And so it's really important to zoom out. And as a general principle, if you're feeling nervous, zoom out. So I wake up and I check the US markets every day when I wake up. Sometimes everything's bright red. Sometimes everything's bright green. And naturally, when it's bright red, you're like, ooh, what's going on? And when it's bright green, you're like, I'm a fucking legend, right? So excuse my language. But like but necessarily you need to zoom out. So when it's like, when everything's red, I'm like, okay, like because again, I've developed the muscle, I actually don't get that upset. I'm like, oh, interesting. And then I zoom out and I'm like, all right, where are we? Where are we in this whole thing? Like, are we in the right secular trends? Is this, some external thing, So like, and I just zoom out and then I go, okay, don't worry about it. Move on, carry on. crack on. And so I think zooming out is really, really important. And I think just having the situational and emotional awareness that you as a newer investor haven't yet developed the capabilities. And I say this respectfully, right? You haven't developed the capabilities, experience, calluses, muscles, intuition, all that kind of stuff to be able to let your emotions get in the way. And so you necessarily need to be able to express them. I'm feeling nervous. And then you need to see, and you need to be working with someone you trust. Because if you don't trust someone, then I mean, that's a bigger issue. Right.
Mm.
So, I would just lean into that, and I would just, and zoom out and go, okay, do I believe that this location is good? Do I believe that the timing is good? Do I think that if I held this asset in 2 to 3 years' time, I would be happy with owning this asset? If yes, go for it. I think it was Peter Lynch, or maybe one of the other, big dogs. And this was about stocks, but he said, whatever price you're paying for a company today, you're not buying the company today, you're buying what the company is going to be in 18 months' time. And the same kind of thing is true for property, by the way. The same kind of thing is true for real estate with a slightly different twist, longer timeframes. So you're not buying what the property is today, you're buying where the property is going. Now, that doesn't mean that if you think it's going to go from 500 to 1 million, you should just pay 1 million, because obviously you're just going to chew up all your gains. But you need to remember you're entering into a market for where it is going, not where it is. Mm-hmm. And I'll make a few more points on this because I think it's an interesting sort of tangential place to explore. We have been in environments where if you looked at the listing price versus the price that our clients were paying, you would say that we were overpaying for properties by a significant margin. There have been many markets that we have been in where the list price, I'm just going to use examples here, the list price might be $500,000 and we're putting in offers at $600,000, right? And you could reason, to the untrained eye, you may say, "Oh my God, are we overpaying for properties?" And to be completely frank, the first time we encountered these kind of markets, we were confident we were making the right choice, but still, at least some part of us was like a little nervous. It's like, well, geez, like we're confident, but it's a long way. It's a long way out. There's a really big disconnect between the price representation in the market and the actual market. The big disconnect between those two things. In 100% of those scenarios, all of our clients have absolutely smoked it. So what it turned out to be more true was that the price we were paying was the appropriate price to enter the market at that point in time, and we were picking the right secular uptrend, the right locations at the right times. No one's ever been concerned after the fact that they paid too much money. Now, the other point that I want to make on this is that what I've noticed is a trend of people having too much of a fixation on short-term returns. So it's very important to remember that you are look, the average holding period for Dash clients is about 3 to 5 years. Some clients are just like hold forever type people, but we have a lot of clients that sort of sell in the sort of 4-5 year sort of range and rotate their capital into other markets. Very common, and that's also part of the reason why our clients are so successful. But what I've noticed is a greater fixation on short-term returns, like people buying properties, and then 6 months after they bought a property, we might do a valuation, or maybe they'll go on realestate.com.au or something like that, and they'll be like, my property hasn't grown at all. I bought a dud. Rah. It's like, calm down, right? Just calm down, because you're not buying properties for what they're going to do in 6 months. You're buying properties for what they're going to do in 24 months, 36 months. And even to that extent internally, we have recently just kind of started to discuss, mandated that we don't even talk about 12-month returns anymore, because it's the wrong framework. We're very proud of our 12-month returns. The average return on invested capital for Dash clients in the first 12 months is about 70%, which is wild in the first 12 months. And just as a reminder, we've bought over 2,400 properties, so that's a pretty good batting average. The problem with that is then people start to think, what is this property going to do for me in the next six to 12 months? And that's a problem, because actually you're trying to enter into a really strong secular trend, or in a subsector within a stronger secular trend, And by the way, our average return on invested capital over 24 months is 168%. So actually, there's almost another 100% on top of the 12 month. And so just zooming out and going, what are my timeframes? What are my timeframes here? Am I investing for the next 3 months? No. Am I investing for the next 3 to 5 years, possibly longer? Yes. Okay, good. If I bought this asset, do I think that this asset is in the right suburb at the right time? That's a good starting point. Yes. Okay, good. Do I trust the advice that I'm getting around this? Do I believe in the people that I'm working with? It's very important. And if you don't, you should be, right? You need to have that. You need to have that relationship, right? If all these things kind of tick, just zoom out, take a deep breath, and just take action. More wealth is created by taking action than through analysis paralysis. In fact, this is actually a Peter Lynch quote, which I love, and it's not exactly appropriate to this, but it's directionally appropriate. He says, more money is lost waiting for corrections than in actual corrections. Now, I'm not talking about corrections here, but the point there is that people overthink things. People are constantly overthinking, like, oh, no, I don't want to do this. No, I'll get the next one. Or that property is not exact, it doesn't tick 100% of my boxes. So therefore, I'm just going to pass. And until I can find a property that meets 100% of my criteria, I'm not going to take action because it's got to be perfect because this is a lot of money and there's a lot at stake here. And this is my future. And I'm just worried. And just unless it's perfect, I'm not going to do anything. And then as a result, they don't do anything because nothing's ever perfect. Nothing's ever perfect. There's always going to be trade-offs. And so as a result, they do nothing. And as a result, they get behind. Whereas people who take informed action consistently move forward. And so having a bias to be able to lean in and do something brave and take the leap, because it's difficult. It is difficult. When you are investing, when you know that what's at stake is your family's financial future, your financial future, your hopes and dreams are all wrapped up in this thing, and you're about to outlay a whole bunch of cash, and you're like, what if I get this wrong? What if I jump out of the plane and the parachute doesn't open? Right? But at some point, you're going to jump out of the plane. At some point, you're just going to take a big, deep breath and dive off. Now, using that analogy, by the way, if you were going to go skydiving, what would you want to do? You would want to know that your parachute was packed correctly. You would want to know that you're parachuting with a reputable company. You would want to know that they've got a good track record of safety. You would want to know all of these things. So when you're standing at the edge of the airplane and you're about to jump out and you're freaking out and you're like, oh no, I'm going to look at the ground all the way down there. I'm going to die. And you can tick those things off in your head. You're like, okay, this is a good company. I did my research. I trust them. Like the parachute's packed correctly. It might not open. There's a chance that it might not open. Because of course you don't go skydiving without at least acknowledging the possibility that you might go splat. You have to. That's part of the thrill. Right? But you're like, the probability is pretty small. Okay. I need to trust the process and I need to jump out of the airplane and go. And you know what? Most people say, I haven't been skydiving. I actually know a lot of people have. 100% of everyone that I've ever spoken to who's gone skydiving said that they were terrified and they jumped out of the plane and they were freaking out for the first little bit. And then once they hit terminal velocity, it became the most fun thing they've ever done. And it was just like, oh my God, what a ride. And it was so exhilarating. The same thing is kind of true for property. It's like you take the big first leap, you buy a property, you're not even sure in that first little run, you don't even know if it's working out. You've got no point of reference. You're just like, oh my God, all my capital's gone into this and I'm checking realestate.com every day and the valuation's not doing anything and you're freaking out. 1 year into your journey, 2 years into your journey, 3 years into your journey, you're like, this is the coolest thing ever. I'm making money. Life's easy. I know how the game works. I've got a good team around me. I've built hundreds of thousands, maybe millions of dollars of wealth. Why was I ever worried? And by the way, mistakes will happen. Mistakes will happen along the way. Not every property is going to be perfect, but through consistent action over time, that will smooth out any of those issues. Right? Because even if you did accidentally buy a property that didn't grow very much, or you bought a property that had some major issues that you needed to dump a bunch of money into it, consistent action over time is going to smooth out all of those problems. You won't even worry about it overall, because you might have something. Oh, I had a $40,000 expense on a property. Okay, well that kind of sucks. But in 3 to 5 years, when you've made $1 million of upside, your $40,000 is not going to be that big of a deal. So, you know, we can move on from that. Anyway, thoughts?
A lot of thoughts on, because I was just thinking about the reality is like the acquisition of a property is the most stressful part, and this is where all these resistances come up the most. The reality is if you go ahead, you buy it, you work with someone that's helped you to buy the right property in the right place at the right time. Fast forward to 2 years, the actual day-to-day experience of you owning that property is you have a property manager who deals with it all. There might be some maintenance. They come to you, they say, hey, here's a quote. Do you want to pay this? Yes. You don't have to deal with it at all. If you work with Dashdot, we will also be monitoring the performance of your locations as well and giving you insights. If you don't work with us, other people don't do that. But if you have our team, you have that to not even worry about as well. So it's not actually that much for you to do on a day-to-day level. Like I know there's a lot of people that are watching now and will be listening to this that have a few properties. Sure, there's maintenance stuff here and there, but largely if they've got good property managers, it's relatively hands off. I'm not going to say it's passive. It's not passive. It's an active asset, but you have management that are in place that deal with the day-to-day. So it's just that first friction point to get through. The other point I wanted to point out, because how you said about the skydiving analogy, I was thinking this through because in that analogy, the downside is death, right? Your parachute doesn't blow out. You hit the ground, splat. It's all over. That's a big downside for you to consider when you're making that decision. With a lot of this, it's actually just thinking through what is the absolute worst downside here and getting comfortable, firstly acknowledging that, but getting comfortable with that potentially being a situation. And I'm not saying that this is not something to worry about because money is very important to people, but at the end of the day, it is just money. Like it's not your health, it's not other things. And if you end up buying a property and then turns out something goes wrong or you're not happy with it or whatever, you can sell the property. Yes, there's costs involved with that. Yes, you may lose a bit of money in that situation, but it's not something so scary to just completely stop yourself from going down that path.
Yeah.
And I think this is a really important, so something we teach with the team is this concept of one-way and two-way doors. So like a one-way door is something that you decide and you can only go that way and you can never come back. And so you have to be very, very clear and certain when you make those decisions because you can't come back from those. And I think a lot of people think with property, like it is a one-way door. Again, because a lot of people spend a lot of years building up deposits and then getting their finance together and getting to the situation, like it has to be right. But the reality is it is kind of a two-way door.
Yeah.
You might go backwards a little bit when you come back through the door, but you've gotten bruises, you've gotten scars, you've got wisdom that you're like, okay, I made that wrong mistake. I turned left here. I should have turned right. But you can come back from that. And so don't let that stop you from stepping through the door in the first place.
Yeah.
Is this how I would think about it?
Yeah. No, I think you're right. I think it's a good point of view. And also, by the way, like, and I learnt this, worked it out, kind of thought it to myself when I was less than 10 years old. I was like, money is the single commodity. It's the single tradable commodity in the world that you can always get more of. It's the only infinite commodity. It's the only one. And so, yeah, it sucks to lose money. No one likes losing money, but it's just money and you can get more of it. And also, you know, failures can happen in real estate, but it's not a reason to stop. I remember our very first client, Lucas, and I think we've helped him to buy 4 properties now. I think it's 4 properties now. When he came to us to start working with us, he had tried to invest twice and he'd failed. So 2 times he'd tried to invest in property and 2 times he'd lost a bunch of money. 2 times, that's it. He'd tried twice, bang, bang. So, you know, kudos to him for stepping up to the plate a 3rd time. Like, kudos to him because he'd lost a bunch of money 2 times in a row. Not good. And he was terrified that he wasn't going to be able to be the provider for his family, set him up with the right financial future. He was terrified of all that kind of stuff. 2 bad investments, then 1 good investment. That turned everything around. Turned everything around. Now he's on 4. So he went from 2 losses to 4 wins. And so he didn't count himself out. He didn't just say, oh, okay, I made a loss that's it, property is not for me or whatever, he got back on the horse. And in doing so, and obviously by working with the right team and doing all that kind of stuff, as a result, he's now thriving. He's absolutely killing it. And that property totally smoked it. It was actually hilarious because I asked him for a review and he said, no. After we bought the property, he said, no, we're going to wait 12 months. We're going to wait 12 months. I'll make my judgment
Fair
then.
enough. Yeah.
And so I was like, all right, dude. And
I will cast my judgment in 12 months.
Yeah, and look, cool, all good, like no stress. And then 12 months later, I can't remember what the numbers were, but it was bonkers, right? And so he was like, okay, this is everything.
And has continued as well.
And has continued, right? He's totally killed it. There's a question here in the chat, which I want to.
Some good questions, yeah.
There's some great questions in here. Which one do you want to tackle? So I was looking at Gavin's in there.
Yeah, both the last two. So we'll do Gavin. So is there a reasonable time frame to evaluate your investment to know whether it's a dud or not? Is 3 years a safe timeline?
Yeah, so I think that you can continuously evaluate, but just be cautious about how you interpret, is what I would say. Because you have to have a thesis. Like, why have you invested in this location? Now, I'll give an example. There was I'm actually not going to mention it. I was going to mention the suburb. I'm not going to mention it because, well, it's about to go off. So I want to keep that little keep that fact. There was a location just over 12 months ago, I'll roughly say 18 months ago, that I was bullish on and I advocated. I was like, guys, we've got to buy here. We've got to buy in this suburb. And everyone else was a bit like, are you sure? And I was like, yeah, I'm certain. Open it up. Let's go. And so we did. And 12 months later, the clients that have bought in that location had some of the lowest returns that our clients had seen over a 12-month period, right? So they had some of the lowest 12-month returns. And so necessarily we were like, "Ooh, shit. Did we made a mistake here?" And so we went back and we checked our own thesis. It's like, okay, did we do something wrong here? And turns out we were just a little bit too early, because every marker that we had looked at over the 12 months had improved. Every single signal that we had in our system was pointing more to the fact that that location was about to go off. And so, some clients had, we'll call it mediocre growth. No one had lost money, right? But it was just mediocre. And we went back, this is to Gavin, to your point. So this was like roughly 12 months in. We were like, okay, is this the wrong place? Like, do we need to be talking to these clients and saying, hey, look, we made a mistake. We're going to move out of the suburb or whatever. But actually, when we looked at it, every single thing that we could look at pointed to, no, the conditions now are better than they were. Oh, we were just a little bit too early, which is actually good, because those clients are going to catch the entirety of the upswing. Now that market has started to move, and it's going to go off. It's going to go off. Like every signal is pointing in exactly the right direction. And so I think it's appropriate to consider at any point, 6, 12, 18, 24, but it doesn't mean that you take action on it. So let's say after 12 months, your property has not performed, I don't know, as well as you would like. And I would remind people that, the national average growth rate over the last 12 months is like 5% or something, 4.7, I think it was in the last, I don't have the latest chart back, but, roughly 5%. So a lot of people are like, my property only grew by 10%. It's like, well, the national average is 5. So, relax. But if you assess after 12 months and it hasn't met your expectation after 12 months, you can reasonably say, okay, that's cool. Is my thesis intact? Do I still think that this is the right location? Is it just a timing issue? Because it could just be a timing issue. Maybe you bought a great property in the right place, and maybe it's just a timing issue, because like timing can be a little tricky. So I think you can assess it, but it doesn't necessarily mean you need to jump up and down and be like, oh my God, I bought a dud. It's like, it's a long game. It is a long game. Maybe you're going to hold that asset for 5 or 6 or 7 years. And maybe it went up by 5% in the first 12 months, but maybe then it goes on to go up by 100% over the next 2 to 3 years. And if you judged it on its 12-month performance, you'd be making a really big mistake. So I think it's reasonable to continue to assess and like, okay, is my thesis intact? Go back to what we're talking about earlier. Bitcoin's price has dropped significantly over the last month. It's like, yeah, okay, but like, is the thesis intact? Is it just price? Like, is there something that's broken, right? Is it suddenly not decentralized, or is it suddenly not secure? No. Okay, fine. All those things are intact. So I think it's okay to assess it, but I don't necessarily think that needs to translate into judgment. Just curiosity.
On
That
just
will guide
quickly
you.
on that,
Go on.
yeah. When you say has the thesis changed, what are some examples of things? Like what do you mean has the thesis changed? Like let's talk about property specifically. If someone owns an asset in a certain location and they're
All right,
reviewing 2 years time, what might have changed?
I'll push it to the edges because it'll make it a bit easier. Let's say that you bought. Let's say you heard there was a mine opening somewhere in the outback, and you bought a property in the town next to that mine because you were convinced that that mine was going to open up, and as a result, the property prices were going to boom.
Yep.
Obviously, very speculative, but I'm pushing it to the edges just to make the point. And then it turned out that the mine was never going to go ahead. The company's gone bankrupt, or there was no minerals there like they thought there was going to be. So there's no mineral deposits, and it's never going to be developed, and that's it. Well, then the thesis would have changed, right? Yeah, the thesis around why you had invested there has broken, and you could reasonably assess, like, okay, probably just need to cut my losses and move on. And the benefit of real estate is actually that the thesis is so broad and strong that it's sort of a reasonable thing to assess. It's actually, how do I put this? It's easy to get it right if you know what to look for, right? There's obviously, it's easy to make a lot of mistakes too. But for example, let's say you understand that people are moving to affordable suburbs because of cost of living. If you understand that population is continuing to grow and supplies is diminishing, right? So if you pick a location because you're like, I believe that people are going to move here because it's at an affordable price point. There's a lot of jobs available. It's a desirable location to live. There's good schools for young families, and immigration is continuing to increase, and all of that kind of stuff. Then that's pretty hard to break that thesis, right? So there would have to be some kind of fundamental thing that would stop people wanting to live there, or that's going to pull people in other directions. And some people get a little overly stimulated by, like, oh, this major project is no longer happening. It's like, okay, like maybe that's not ideal, but in general, is the economic thesis for that location still intact? You know, we've had locations where we've been buying for clients, and like the number one major employer in that location has made an announcement that they're shutting down. We obviously couldn't have possibly known that on the way in, right? And obviously, when something like that happens, it's like, oh, this could be a problem. But there's literally been 0 cases where that's actually caused a problem for our clients. So, you know, it can cause a little bit of disruption, can cause some, you know, market sentiment disturbance, but generally there's still enough other drivers. So it really becomes more prescient if there's like single point sensitivity to something, like I'm buying here because of this one project or something like that. In which case, if that project changes, so
which is inherently where risk comes in, right?
Yeah.
If you're just basing it on.
Sorry.
No, it's just if you're just basing it on one factor, your hypothesis is built around one particular thing.
Yeah.
Then if that goes, that's 100% risk of that being a bad investment in time. I was just thinking, going back to like the dating analogy, it's like you have these criteria. So let's say you have like 3 different things that make up your hypothesis, that like you're attracted to them, you have the same sense of humor, and they're a good person. If in 12 months' time you're still attracted to them, still got the same sense of humor, but they've demonstrated things that demonstrate they're not a good person, that's reason enough to question the relationship, right? So it's a similar thing when you're entering an investment, you're defining these characteristics of like, why am I buying this thing?
Yeah.
And then you reassess based on that list of things. And if one of them has disappeared, am I still happy with the 2 that are there, or do I want to reconsider? Have 2 of them gone? Okay, I should probably think about maybe exiting. those kind of things. But it's very getting clear on why did I buy this thing in the first place.
Yeah, and there's three broad categories of thinking: buy, hold, and sell. Right. So if you're assessing your property, you could reasonably ask, like, man, do I still love this location? Would I buy another property in this market today, right now? Would I do it? Okay, you're probably still in the buy zone where you're like, oh my God, this is so exciting. I wish I could buy more houses here. Then you might be in a situation where it's like, okay, this is cool. I wouldn't buy here today, but it's certainly not a reason to sell, right? Like this still looks good generally. So I'm going to continue to hold. Okay, I wouldn't buy again today. I'm happy I bought when I bought. I wouldn't buy again today, but I'm happy to continue to hold in this location.
Yeah.
Then there's sell. And sell could be either just pragmatically rotating capital, or it could be like, something's broken. I need to get out, right? Which is very rare. I'm mindful of time. There's two points I want to touch on. So RJ said, if your investment is timed badly, just wait 15 years. It's very forgiving, given enough time. So RJ, I would agree with that, but part of the point is that market cycles are shrinking. So yes, 15 years is correct, but it could also just be 5. It could be 5. It could be less time than 15 years for it to work itself out. It could be 5 to 7 years, and you could still end up being in a great position. So I think it is very forgiving. That is one of the benefits of real estate, is as long as you're bought in a good location, then sometimes you just need to go away and just like leave it alone and let it work itself out over time, and everything's going to be just fine. So you don't need to worry too much about that. Now, Lily Bean, he said, if we consider an average cycle of 3 to 4 years, the first 12 months are super crucial to pull out equity and accumulate more quickly, especially in the accumulation phase. So there's a couple of things about that I think are interesting. So if the average cycle is 3 to 4 years, we don't know. So it depends on what you mean by average cycle. If you mean average suburb growth cycle, or if you mean average hold period, I'm not sure.
I think, as we said, average hold period. Yeah.
Sure. Obviously, in an ideal world, you would get 500% growth in the first 12 months, right? It'd be amazing. Or let me be a bit more realistic. Obviously, you would prefer to get a lot of growth quickly. Everyone would, of course, prefer that. I mean, if you could buy a property and it could double the next day, you're not going to say no to that, of course. Like, that would be great. That'd be fantastic. And yes, your point, Lily B, is also true, that when you get growth faster, or when your equity increases over a shorter time frame, you are more readily able to rotate that equity out and buy more properties faster. That is true. Yes, that is true. However, I don't think that you should stitch your emotions into that idea. I think that can cause problems. It is far better to remain a little detached and be happy if it happens and be okay if it doesn't. Now, obviously, we've built an entire business around helping people to get great returns and, align with their strategy and all that kind of stuff. And some people get exceptional returns, and some people get okay returns. And on average, which is, an average, people do great, right? But also, if your property doesn't, double in the first 12 months, that doesn't mean it's bad investment. And I think that if we narrow our focus to too short-term thinking, that can actually lead us to either not make decisions or, kind of carry the wrong emotion through the whole process, and it can make everything a little bit more stressful. Because, of course, if your property doubles in the first 12 months, hallelujah, rock and roll, like, let's go. But I think we should be okay in remembering that this is a longer term game. This is a longer term thing that we're doing here. And so making good investments consistently over time is going to get us where we want to get to. Of course, if every property you ever bought doubled in the first 12 months, then great, fantastic. You're going to retire way sooner. And of course, that would be wonderfully fantastic. But I also would just encourage people not to get too fixated on that. And the reason I point that out, and Lily B, it sounds like you're a pretty well-balanced individual from what I can see in your comments. So I don't think you're necessarily being overly neurotic about it. I think you're just highlighting the point that, yeah, of course, if you get more growth, it can accelerate. The reason that I'm laboring the point here to not be obsessed by it is because I've seen particularly recently in the last, say, 12 months, lots
Mhm.
more first-time investors that are looking at their property in the first 6 months and they're like, why hasn't, like, it might have gone up by 10%
Yeah.
in 6 months. And they're like, why haven't I got more growth? Why don't I
Yeah.
have more growth? And they're genuinely pissed off about it. And it's like,
Yeah.
you do realize that that's gone up like 10% or even 5% or even 3%. It's like, just relax, right? It's
Mhm.
6 months. Or maybe, you know, we've had a couple of people recently who've said things like, what happens if I don't get 15% growth in the first 12 months? It's like, wow, why are we even in a position where that is a question that someone would ask?
It's wild. Yeah.
It's crazy.
Again,
Like,
national average last 12 months is like 5% or something.
yeah. And it's like, what? Well, I mean, I don't know. Like, what if you get 7.5 or 10% or, you know, and again, but then what if in year 2 you get 15% and like what is our time frame here? So of course, you want to try and buy in the right property in the right place at the right time. You optimally want to catch the best upswings. You want to do all that kind of stuff. Sometimes you're going to be a little early, so you might not see much happening for the first 12 months. Sometimes, you know, all of these things factor in. And I just think like being too neurotically obsessed with like, what are my returns on a day-to-day, week-to-week, month-to-month basis is a recipe for unhappiness, not success. That's what I would say.
Yeah. And we actually have some clients coming to consider working with Dashdot that say basically, because they're like comparing us with other options that they have and going like, well, you need to give me 15% in the first year. And if you're not going to commit to doing that, then I'm going to go elsewhere. I'm like, what? And hopefully a lot of the Dashdot clients listening to that are like, it's such a silly thing to stop yourself from working with, particularly our team, who will hold your hand through the whole freaking thing of the whole time that you're investing in property. Like all of your assets, we help you to monitor and optimize and everything. So it's such a silly thing to just fixate on. This is a large part for me why this kind of education and getting this kind of content out is so important, because with just like short clips and stuff on social media that you get like 30 seconds to be loud and noisy and brag about a growth stat or whatever, if that's all that people are absorbing, then they have these expectations, and then businesses aren't willing to kind of guarantee those expectations, and then they actually miss out. So it ends up being a worse thing off for a lot of people.
Yeah.
I actually just want to point out, because Gavin's just said, we've just bought our first property with Dashdot last week. We're optimistic. When you sent that through, Gavin, I actually started like tearing up a little bit, and I could feel a big smile on my face, because I still, after bloody nearly 7 years, I still get genuinely very excited when people actually commit to this process for themselves and actually go, you know what, I'm doing it. Let's go. Hopefully, you know, you watch the show, you listen to Goose and I every week yak on about this stuff. Hopefully you can tell that we are the right people to help you. Our team, everything that they've learned and developed, like we've all been working together to do the best that we can for clients to get the best results. We have the strongest results in the industry. I'm pretty confident saying that. And we also, it's not just about the property results, it's about the property results as it relates to your portfolio, which we help you to plan out and tailor it to you. And so I just get very excited when I hear new clients joining and actually biting the bullet and going, you know what, I'm in, let's go. And they're stepping into the abyss. They're not really sure, because nobody really knows. You know, something could go wrong, but they're taking the punt anyway, and they're really just feeling strength in that moment that, like, you know, it's all going to work out, and it's the right thing to do. So
yeah, every client we've ever had has felt nervous.
Totally.
Of course. Anyone who's ever gone through any process like that is nervous. And kind of to your point, just quickly, Gabby, it's not just about individual property purchases. It's how do you build a portfolio that's actually designed to help you to get to your goals. And everyone's journey, everyone's path is different.
Yeah.
And so what that looks like for you as an individual is going to be different to what it looks like for somebody else. We need to accept that. There are no two portfolio plans that are exactly the same. We've done 3,000 of them or some, I don't know, like a lot of them. I also just want to quickly share. Can you share the screen as well, Gabby? Sorry, I got distracted by the chat. We also publish all of our results
we
here.
don't talk about this much.
So, and there's a reason we do this. So if you can go to dashdot.com.au/results, you can see we bought 2,435 properties so far worth over 1.51 billion and created over $373 million worth of growth for our clients. Every single property that is more than 12. So one of the filters that before it gets published on this is it 12 months since settlement. So that's why the first properties you see here are 12 months since settlement. But every single property that we have purchased that is 12 months since settlement or beyond is listed on this website. Literally, like there's literally thousands that you can go through and have a look at. And you can see here that we list the purchase price, the latest valuation, how many months has it been, how much growth has it been, and the return on invested capital. And the reason we do this is for transparency. The reason we do this is to show, hey, look at this individual. Great example. Michelle and Justin, only 10.5% growth in 14 months. 25% return on invested capital. So we're not trying to we're just trying to show that there's actually a mix of results here. But the best investors, the most successful investors, are the ones that stay consistently committed over time to the process. That's what I would say.
Yep.
Cool.
Great.
Sweet. And Blake, yes, you will see yours in there in 12 months. So
you will.
Nice. Okay,
cool.
I think that's all we've got time for today, Gabby.
We do. Good chat. I think based on my notes, I think I covered one of my questions on my notes again. But that is c'est la vie. It was freaking awesome ones coming through in the chat. So they were actually probably way more powerful than what I had written, because what I'd written is based on investors' comments anyway. So I'd rather get it from the horse's mouth and just pick it up when it comes through in the chat. Also, because I appreciate everyone that joins us live. I know it's a fair chunk of time to take out of your week on Fridays, and it's so much better when Goose and I rock up here and we've got great people like yourselves joining us live and asking questions, and we can just bounce it around and it feels like we're all having a chat together. So I appreciate you doing this live with us. If you are not listening to this live with us, if you're listening to the recording, appreciate you too.
And leave us a comment on YouTube, and also make sure you subscribe as well. We've got we love seeing more people subscribe to the channel, and we love seeing the comments as well. So leave us a comment on YouTube. That helps as well with the engagement. It helps more people to get this information too. We just want to help more people. So all of that stuff is useful.
It is useful. Thank you.
Awesome. Thanks, guys. See you next week.
Thanks, guys. Bye.